Hi, I'm Mark Honeybone from Property Ventures, and welcome to our weekly podcast where we interview prominent members of the investment community along with other professionals in the New Zealand property market. This is a free service from Property Ventures so that you can keep current and learn from some of the best around New Zealand. To check us out, take a look at propertyventures.co.nz. We hope you enjoyed today's podcast.
Do you want to someday live off your property investments, retire, or would you like to switch to being a full-time investor involved in real estate in some way? If you're in this space, this interview might be interesting for you. We have Hadar Orkibi back on the show. He was a guest in episode 6 where we talked about joint ventures. And today we're going to hear about Hadar's journey from a new immigrant in New Zealand working in the vineyards in Otago to full-time portfolio manager, a property investor, trader, website owner, in just a few years. There's tons of takeaways from this, and I think for me it's just exciting to hear and be reminded that anyone from any position can make a start and succeed in what seems afterwards and to outsiders a very short time. Enjoy.
Okay, so thanks Hadar for being on the show today. Really appreciate you giving up some of your time again.
No worries, pleasure.
So we've got an absolute stack of questions to dig into today, and I think this could go out across a couple of episodes, if not more. And so Hadar was on an episode earlier on, a couple of months back, and we got into joint ventures, and that's something that Hadar and I are both involved in. But I think we sort of skipped around a lot of stuff and dove straight into, what we're doing now, and it would be really good for some of the people listening at home to sort of go right back to, if people want to work in property, they want to build up portfolios and have passive income and all that. But let's get back to the very start and how you got into property, and we'll work through that to the property cycle and some of the higher power concepts of investing. So if you don't mind me asking, what got you into property way back when?
So before I started full-time real estate investing, and before we even came to New Zealand, I was a real estate agent for 2 years. I was working for myself, selling houses and renting out rental properties.
Right.
I'd always really was more keen and interested in being a bit more active in the investment side of real estate. Doing properties up, rehabbing properties and making money this way, in opposed to working 9 to 5 as an agent fighting for those listings. So I moved into New Zealand around 2003, late 2003, when the property cycle globally, I think, was pretty much picking up steam. That was pretty much the beginning. Early in those days, we didn't have any podcasts or anything like that, but we had, which is great. We had a lot of good books, which I basically literally read pretty much every book I could put my hand on here in New Zealand, and kept myself educated and learned the subject for a number of years, maybe 2 or 3 years. I was just getting myself educated about property. Mm-hmm. I had especially the investing side of it and getting familiarized with the taxations and the legal aspects of it, which it's very important sides of the investing as well as a whole. I participated and read Property Investment Forums, which is an online forum, which I think is a great resource for asking questions and having more experienced investors answering those questions and giving you their opinions. I learned a lot from that. I highly recommend that. If any investor in New Zealand, you can go to propertytalk.co.nz. And there's various other forums if you are based in the States. I know there's a great forum called biggerpocket.com, for example. I got a couple of mates who are based in the States and they invest there, and they think that is great. Also, I was while I was studying real estate and getting myself educated, I was working in here in Central Otago. I was working in vineyards and orchards.
Right.
So within that time frame, it's quite a monotonic sort of repetitive job, picking up grapes and working in an orchard. It's sort of, you don't use your brain a lot. So yeah, within that time frame, I managed to get hold of some good audio books and audio courses of real estate. I bought them through the like of TradeMe or Amazon, and I found that to be great. I've just been listening to heaps of those every day. I got to work there. It was more of a seasonal work, so I wasn't doing it all the time, but in the season I was working pretty hard on that. And those audiobooks were great. So I was keeping my education while I was doing that.
So even before you started investing, started trading, joint ventures, all this stuff, before you could get into that, you were using the free time that you had, or mental free time, let's call it, and you were getting anything you could get your hands on, be it audio, online, or books, and just bringing yourself up to speed.
Yes. And I remember when I started up, really in the beginning, I always heard about investors who you read about in the property magazine, or people who are prominent in the community,
right.
Investment community, who are members, highly regarded members of the Property Investors Association. And I remember feeling a bit not comfortable, or I want to go and, a bit shy to go and join even the association, because I wasn't owning any property at the time and all of that. And it's only when after I've done my first deal, my first buy and hold investment, which I gained the confidence to go and join the real estate, the Property Investors Association, the local one. Every area has got their own local association, and this is something which I highly recommend for any person who is interested in property, or has one rental or non-rental or 10 rentals. It's really great for networking, and it's really great for brainstorming with other investors. And as you grow within the association, the networking part of it becomes really a good base for new opportunities.
Yes.
And I highly recommend that. So joining the local association is really important. Networking is just the more you network, the more opportunities come. So no matter where you are at, I really recommend that. It was really helpful to me.
Well, could you perhaps give us an example of how that being a part of that association helped you in the first, say, couple of years after you joined it?
So, for example, in my local association, I had the opportunity to meet up for coffee with few investors who had more experience than me, who owned more property, were investing for more time, longer before I started. So I could have asked them and brainstorm about strategy and even share sometimes the frustration of finding a deal and hearing that many other people finding it hard to find deals. That's pretty helpful, and it is a lot of support. And when you start up, having that mental support and networking with like-minded people, it's very, very important. So the Property Investor Association, together with the online forums, are pretty much were my core support network when I started up.
That's really interesting, and I find this interesting because with Property Ventures, we have a large database, and one of the things we do is anybody who joins will get on a Skype call or a phone call with folks and talk about where they're at and see what they're trying to do and how we can help. And something I hear all the time is, oh, my partner isn't interested, or my wife doesn't care, or my husband has no interest in this. And it sounds like you, through went out and found your own networks that didn't become, I'm not saying that your partner's involved or not, but you just made that non-issue and went out and created your own networks.
Yes, I had to. My partner is very supportive, but so far she's not involved on the day-to-day running of the business. We have 2 little kids, and being a couple who immigrated to New Zealand 10 years ago, approximately, just over 10 years ago, we had no network of family around. So my partner been doing. Together with me, of course, she's been concentrating on being a great mother and keeping that side of the family going, and while I was trying to educate myself and find something to do here, and once I got the idea about real estate and I saw that and read about it, that there is money to be made. And I remember reading prominent investors, one of the veteran investors in New Zealand, with Ollie Newland, well-known investors in New Zealand. I remember one of his book. I read all his book. One of his first book were in the 1970s, and that was talking about bubbles and bursts and the property cycle. And I remember something that he said, he wrote in one of his books, which influenced me for the rest of my investment career, and why I sort of decided to go with real estate, is that he said, if I decided, it's not exactly, I'm not going to quote it because I can't remember exactly how he said it, but it's along those lines of, when I decided that I want to make a lot of money, I decided that I may as well deal with large transactions. So when you deal with hundreds of thousands of dollars, your profit margins would be larger than dealing with the smaller amount of money. So potentially, generally speaking, and that's something that I always kept in mind, and I always fancied it would give me the drive to try and get it right, so I can also get to that stage when I can trade with hundreds of thousands of dollars and potentially get a good return on investment.
Yep. I've read that book. I think I've dug into Ollie Newland's books too. They're really good. So if anyone's listening at home and you're looking for a book to go out and get, Ollie Newland, all his stuff in the library.
Yes, and he's you can buy it as well. He's just the way he writes. It's really great. It's humoristic as well, and I enjoyed it because instead of having a boring business book, it's just really great, and there's a lot of true stories, and it's applicable to anywhere in the world, really. It doesn't matter if you're in New Zealand or Australia or the States.
That's right.
It's just great. And I had also read a lot of books from authors who are based in America. So some of the tax rules obviously a bit different, but the strategies are the same. And most strategies are the same. We'll get to the point soon in which we can discuss stuff which I was doing when I starting up and which we can't do now in New Zealand, like wholesaling, basically property finding. We'll get to that soon. But what I found with real estate is just it is an international language. Once you know how to research the market and how to stay on top of the market, and you understand real estate and breathe real estate, and know the language and know the numbers and know how to calculate returns on investment, whether it's internal rate of returns, cap rates, or just yields, you can go to any market and get to know the local lingo and the local tricks and pick up and do business.
So, and one thing I've found, I'll add into that, is people who are already doing this for a living or are deep into it will happily sit down and tell you anything you need to know. I just find people in property who are doing it a lot, people in anyone who's really loves, it's almost like a hobby. People love sharing what they do with that they're interested in. They might not sit you down and tell you exactly what deal they're working on, because that's their business and that's how they're planning on making some money in the near future. But in general, coaching or ideas or concepts or feedback, I find property people just great to bounce ideas off.
Yes, because I think people who truly property investors, it's a breed of us who really passionate about it. And for me, when I started real estate and was reading all those books, I probably got at least something like, I don't know, 30 or 40 books in my just about real estate, straight out books. and I read all of them. And some of them I go to reference for various things if I want to know, for example, about lease structures, or if I want to look up some clauses which I could potentially use in a deal. I go up and look on some strategies or exit strategies, just to refresh my memory. And I think that a lot of people who start up, and generally speaking, you sometime within your investment route, you get to a point when it's really difficult and you don't find any deals or you can't get the finance. So having the opportunity to network and come up and discuss it with the fellow investors, it really helps to move forward and share ideas how to keep rolling, because everybody who's been in the game for long enough, been through different situation or similar situation, which can save you a lot of stress and time and money if you discuss it with somebody who's been there, and you just sometimes need a little tip to be able to pick up and get motivated again and move on.
Yeah, absolutely. I think you're spot on there, Hadar, and I totally agree. So you did your first deal, you bought your first rental, and you joined the PIA down there.
Yes.
And so what came next?
So then I read a book by an Australian author, which was a great book. I loved it. It was really good. But he was talking about the property market.
You have to tell us the name of the book, Hadar.
It's a name of the book. It's the author was Michael Yardney. And it's a great book, and I can't remember the name.
All right. Well, we'll find out the name of the book, and we'll include it in the show notes, everybody.
Yeah, put it in the show notes, that's for sure. I can go and get it from the library if you want. Just 1 second. Yeah, so the book called How to Grow a Multi-Million-Dollar Property Portfolio in Your Spare Time. And I think that it has a few editions now. It's a really good book. It's really a lot of details, and it has a lot of the detailed information, which is really important. And I recommend books like that because it has a lot in it, and it's really worth it. The one thing that I didn't understand was that he was talking about the Australian market in general. Where in the capital cities, for example, Melbourne, where he's based, Sydney, and let's say even Brisbane, properties there are high-yielding properties are quite hard to come by, meaning you can't really get a property in Sydney which is returning 10% net return or properties which will be cash flow positive. So he's talking in the book a lot about buying properties in very good locations with added value opportunities where you can develop the property in the future, which is great. But that particular strategy for me when I was starting up, and I didn't know that at the time, wasn't suitable for me, especially because I was based in New Zealand and there were some deals and properties in the New Zealand capital cities which return a greater return and could be more of high-yielding cash flow properties.
Right.
So I went and I bought a property in Christchurch. Again, I always invest. I always been investing away from where I live because I live in a town which there are at the moment around between 4,500 to 5,000 people in the area. And I knew that there's not a lot of opportunities here, and the returns were pretty low. So I ventured into the Big Smoke, a city with around 300,000 people. And I looked for deals and I advertised in the paper. I did a lot of private advertising and ran it through my website and put some mail drops as well. Whether it's yellow letters or just in the paper, ads in the paper, looking to buy particular areas in suburbs, which I know that the majority of the properties over there are sitting on land which is a high density land. And I bought this property I got a phone call from the owner who wanted to sell. He's been there for many years. He paid something like at the time he paid something like $75,000 for it in the 80s, and I bought the property for $300,000, and I thought I got a good deal.
Right.
So that was the first one I bought. It was a house converted for 2 flats. But still the yield was better than a normal house, but it was still very low comparing to being anywhere close to cash flow positive. And I had to put a reasonable deposit in to get it sort of cash flow neutral. I know you have a lot of listeners from the States, for example, from America or other places in the world, when you can find properly cash flow positive properties, let's say net 10% net return, I want the listeners to understand, and I'm sure you will agree with me, that in New Zealand, capital cities like Auckland, Christchurch, and Wellington, or even Tauranga, which is cities with few 100,000 people, in a good locations, it's just there isn't any property. We don't have properties like that over here. We don't have properties for $80,000 in the capital cities of New Zealand.
No, not anymore.
Not anymore. The yields have gone down significantly, yes. So we just don't have it. It's just the matter of the market. The market is just too small the country is too small to have that selection of range of population, which will reflect to more housing and more supply, which will have the opportunity to buy properties for those sort of return. We just don't have it here in New Zealand. You can buy a property for $60,000, what it will be in a town with 5 people, 5 families, and a dead town with basically nothing going on for it. It's just going to be a ghost town pretty much.
Well, good luck if they move out too. Yeah.
Yeah, somebody sent me an email through my webuyproperty.co.nz website, which is doing quite good at the moment. Somebody sent me an email. I get a lot of inquiries about people who want to sell their property, and I got an email about somebody who want to send me a section for something like $5,000 in Ojai, down Southland. It's an old mining town.
Right.
And yeah, just no.
No,
thanks. I want to get it free, because even if I take it for free, probably the rates are gonna just not. It's not worth it.
No,
the tax rates, the land taxes. Yes. So anyway, got back to that. I bought that property, and I got a good deal at the time. The property was worth more than what I paid for it. So I've done my property hunting well. I have researched the market. It took me a while to find the deal. Another deal I bought right after that was through an agent who has been networking with there, and that was another property which was sitting on a development land. And I'll give you an example of that deal. I bought that. It was a quarter of an acre, which is 1,012 square meter site. You could build there up to 6 townhouses on that, and great added value opportunity. You can build up to 2-story or 3-story high. I purchased that property for $370,000, while it was worth at the time. I had a registered valuation and appraisal for $425,000. So I made an equity at the time of $55,000. And the return was okay. It was around 5% gross yield, which was relatively higher than the median rent in Auckland City, if you compare that, where the demand is quite high, where most of the population of New Zealand are actually living. The first property which I bought there with the 2 flats from the fella who owned it for many years, I sold that property after the earthquake. I had a minimum damage to the property, but it just wasn't performing, and I had too much capital tied in it. It was the only property I sold, which was actually intended to hold long term. In those days, I still wasn't doing property trading, wholesaling, property finding. At that time yet.
Right.
I was mainly concentrating on building and buying whole portfolio. So soon enough, I realized that I'm stuck. Those two properties, I sold one just recently, but those two properties which I bought then in Christchurch wasn't generating any cash flow. I had a bit of equity in them and good development potential for years to come, but it wasn't really servicing my cash flow, and I borrow more and more, and then the serviceability is not there. So if there's no cash flow, you basically get to a position that the bank won't lend you any money. So what I'm saying is that I didn't know that properties like that will hold me down, will slow me down. So that's the point I was trying to get to. That's how if I look backwards, I shouldn't bought two of those properties. Preferably, I would have kept the one which I already kept now, which is the larger one. We could build 6 townhouses on, and just traded the other and made some profit. I bought it for 300 and it was worth 360 when I bought it. So I could have traded it straight away and made a couple of, maybe after tax probably would have made around 40 grand or something, and used that for a deposit on another high yielding property. In New Zealand, when we're talking about residential high yielding in the capital city, we're talking about anything between 10 to 8% gross yield. That's before expenses, which is probably around 7 to 6% net yield. So moving on from there, I was basically didn't have any cash flow from those investments, and I got confident enough to get in the game and start trading. And I created a bit more of a network of agents and through the associations. I also joined the association in now, for example, in Auckland, because I'm now active in Auckland and trading and also buy and hold long term. So I joined the local association over there. So I'm a member of 2 associations at the moment. And going back to those days, I was then decided that I need to start creating some cash flow from property. I thought I was quite good by finding deals at a discount. And through property forums and networking, I realized that I need to concentrate on more high-yielding properties, more of a cash flow properties. So I started property finding and wholesaling, what they call it in the States. That's basically assigning contracts for a fee or doing double settlements, contemporaneous settlements. I done it quite a few years ago now, and that went really well. I managed to get the domain name at the time of earlier of webuyproperty.co.nz, and a lot of people, other investors, signed up to my list, and got a big database of investors who joined up and was waiting there for my direct email marketing for the deals I was finding. And the good thing was that those days we could have do all those trading and create money out of property without using none of your own money. So property assigning contract was the easiest way in the world to make money out of property. You basically get a property under contract, and you sell the contract for a fee, whether it's 5,000 or 20,000. And if it's a bigger margin, then you just contemporaneous settle it. So you double settle it, you close it, double closing as they call it in the States. That soon stopped. I managed to build a good database and made some money out of it, but that soon stopped when the Real Estate Agents Authority, the REAA, decided to crack down on all those property finders, wholesalers who are acting as illegal agents. It is my understanding that they see you acting as an illegal agent if you bring about transactions of the sale of land without actually having license. This is really. It was really worrying in the beginning, because that was how a lot of us were making money. You know, it keeps you in the market. You trade properties. It's low risk strategy, And by not needing to have a loan on your name, you're just basically selling contracts or doing a double settlement. For anybody who doesn't know what a double settlement is, for example, I get a property under contract for 100,000 and find a buyer for 120. And if I need to settle to close on my deals on a certain date, I basically receive the 120 from my buyer and take the 100 which I need to pay for my seller and keep the spread in the middle, which is 20,000. That's double settlement. That's happening all one day. So my name will be on the title for around 2 minutes, while the lawyer is just transferring the ownership of the title. So I've done that before the changes for the REIA and before the REIA has made it clear that it's been a grey area and pretty much outlawed. A lot of people like Mark Honeybone and various other buyers agents went and got licensed, and that's the way wholesaling is in New Zealand now. You have to be a licensed agent, buyer's agent, to be able to walk that way.
Fixed fees, etc., or fixed. It's basically an agent. I'm Mark's business partner. If you're listening at home and didn't know, but it's a fixed fee for going out and doing the same work that a property finder was doing a long time ago. And I think the REIA has been pretty active about making sure these new rules are enforced. So I think you'd probably know a bit more about that than I do.
Yes, they've done. They busted few people out. Some of them got fines of 100 grand or 200 grand and stuff like that. So I was really not interested to get in trouble. I mean, we are law-abiding citizens here in New Zealand. And I had no interest to do anything which is even remotely against the law or not workable. So for me, it was actually a blessing in disguise. The property finding job was very demanding. I was spending around 8 hours a day in front of the computer and on the phone, and really hours weren't hours. I used to get agents calling me at 9 o'clock in the night when they finished their meetings, and in the weekends I had no time. Luckily the kids were young at the time, but it was very, very demanding job. And for me, the blessing in disguise was that I had to stop that and basically settle, meaning close on every deal I want to buy and trade and rehab and renovate and sell. So I started doing that, and effectively I ended up making more money and also having the opportunity to have more time with my family. So because when you go into a deal, you purchase the property, you settle on the property, you do the job, you work on it. That could take anything from 2 months to 8 months, typically. And within that time frame, if I only concentrating on one deal, I will be getting paid at the end of it. But I only need to manage the project meanwhile, so it gives me a bit more free time. And once you get better to it and you got systems in place, it makes it easier. And that's what how it evolves. That I went into the next level of actually doing the transactions on my own and obtaining the finance, and managed to save some deposit when I was doing all this wholesaling and property finding. But I leveraged off that to start trading and settling and closing on properties myself, and just go from the first one to the next one and so on.
Was this about when you started looking for JV partners?
JV partners was a little bit later on. I had a situation when I did look for JV's partner earlier, and then I sold the one after the earthquake in Christchurch, and that releases some equity. So I was free to actually go and buy a couple of more buy and holds, which were much more higher yields property the yields were much higher. Still, it's nothing like a cash flow when people talking in other country, like in the States. You literally get, $100 or $300 or $1,000 a month from a property. All those multiple income property, what they call the
duplexes and fourplexes.
Duplexes and the cash flow is greater over there. But I bought good blocks of flats in Auckland and a couple of houses with multiple incomes. So it was a better use of the money, and the return was there, and still had the element of adding value to those particular properties which I bought. The most important thing that happened through those first stages is the evolving of actually losing the day job of being a wholesaler, a property finder all day, monitoring for deals and having those breaks in the middle when I'm in the development, in the deal.
To step away from that, I mean, it's interesting to see, I think there's a takeaway for folks listening to this, that you didn't sit down at day one when you're planning to go into property and say, I will be a successful trader and have big joint ventures and do all this stuff and have websites and things. It sounds like you sat down one day and said, I want to start investing, and then you did the next logical thing. And you just kept doing the next logical thing that made sense for you at the time, and it built up. Rather than, because what I hear and something I get all the time is, it just seems so far away, so difficult. People who have done all this, they've got all these networks and got all this stuff there. But instead of looking at what somebody's got or has set up or however their systems are in place, etc., it's really interesting to come back right to the start. And what I find interesting about what you did right at the start and all through up to this point is you realize that what your next step was going to be, and you did the research, the networking, or whatever was required just to make that one step and focused on doing well with that one step, instead of thinking 10 miles down the road and thinking, it's actually too far, I can't do it, and not making that step.
Yes, it's very important to plan ahead and have some goals and basically, the saying, if you fail to plan, you plan to fail. So you really need to have some sort of route map, which you say to yourself, I want to do that, I want to achieve a greater cash flow, and plan. And even if you're unsure about which way to go, network, get some advice. There's free advice everywhere there. I got heaps of advice through colleagues from the Property Investors Association and online forums. I didn't even know that you can buy multiple income properties like home and incomes, or build a minor dwelling on another property in the back so you have two houses and various things. I didn't know about it when I started. It's all through the networking and the online networking, and it was really, really helpful.
You're working through this process, you're learning the steps, and you're evolving your investing strategy. So what are some examples of, say, a mistake that you made early on, or something that you did then that sounded like a good idea, but now knowing what you would do differently?
Most people you talk to will probably tell you, I wish I started investing earlier. My main thing, which I would like to if I could have gone back to understand, would be counter-cyclical investing. As Warren Buffett says, be greedy when others are fearful and fearful when others are greedy. I bought that first property in Christchurch in 2007 when the market peaked. The GFC was just starting to hit the world. And I bought that. I got a good deal at the time. I bought a property undervalued by 15% and got a big chunk of equity. But later on in the years, in 2011 or even 2010 or 12, that's just with the earthquake, because the property weren't damaged at all. It's only cosmetic stuff. I couldn't even get that for it because we were in the recession. So if I would have waited, for example, and not bought those properties and, maybe learn a bit more along the lines, I could have gone to Auckland straight away, where the market is larger and there are more opportunities over there, and used that capital which I had to start with a little bit as a deposit, I could have used it to buy, cash flow of properties or higher yielding properties from day one in a higher capital growth area, which is Auckland, which has got the higher capital growth in New Zealand. So that was probably the thing. But when I look back on the sequence of events, I realized that that's the steps I took, and I learned from those steps. So I'm not really sorry about it. I just wish I had a bit more of an understanding of the cycle, how the property cycle works, and being counter-cycle is, don't be in a hurry to jump into the property market if the timing is wrong, just because you really want to. But saying that, taking action and getting into the market, it's key for starting building your confidence, and you have to put your toes in the water to actually start engaging and starting getting the emotion of picking up some sort of momentum. But again, getting yourself educated and getting advice, which was, although I did a lot of networking online and a lot of property investors associations, I was still in a small town, and I wasn't being able to go for coffee with people twice a week to talk about properties. See, I got a guy who's we are mates now, and we met in the association down in Otago, and he comes up to here to Alexandra once a month, and he buys me lunch, and we talk about property, and we share ideas, and I give him some free advice and just discuss things and strategies, and it's great. It's great to see, and it's great to give back as well. And it's great to be able to do that. So going back to your questions, like I say, counter-cyclical investing, it's the key. I would have liked to get into the Auckland market a bit earlier and target the right properties earlier, which will not put me in a position that I can't borrow anymore, which I used. And so I sold the one in Christchurch and then went and bought some more in property. And that was when after I bought those other buy and holds, that was when I basically started looking more intensively for joint ventures, because at that stage I couldn't basically buy any more trades, because all my borrowing went on buy and hold, and they were not producing any cash flow. Well, not enough cash flow. They were great buys in New Zealand standard, but you didn't see any reasonable cash flow out of it. They were all 8% in central Auckland, and everybody would love to. A lot of people would love to buy those properties, but that wasn't really possibility there. The other point I would like to mention is sometime when you do a due diligence on a deal, I've done some due diligence on those sections over there, which were the houses that had high density. I wanted to see what will be the opportunity to develop those lands and create some cash flow and multiple incomes. And I went and paid a few close to $20,000 all up, including some financing costs and stuff, to some professionals like an architect, while I could have done that through a draftsman. So so while a small tip from another fellow investor taught me pretty well that I could have got it for probably half the price from just a draftsman for starters, just to get the preliminary submission to council to see if the plans are going to pass and all of that.
Oh, sorry to interrupt. I hear a similar story around paying too much for accounting. So when people are just starting, getting in and going all in on complicated structures and expensive legal advice, and really worrying a lot about that, and just spending too much money up front on just even setting up their entities to invest. So this sounds like a similar sort of a story.
Yes, when you start up and you don't know what you don't know. So again, networking with other fellow investors and perhaps seeing what structures they have, or getting recommendation for accountants, that's an added bonus. There's some companies who charge an arm and a leg, and it's not necessarily justified. Your accountant in your small town or somebody who is good with, property accountant, but is not a large, big firm, can do the same job. But often you need to pay good money to get good advice. So it's really a matter of an individual making sure they get somebody good on board, somebody that you may have been referred to by other fellow investors. Another point I'd just like to make sure, which is key when you start up, always get a second opinion about if you're doing up properties, if you're rehabbing properties, or even if you buy properties which you think they're under rented, which is a great way to add value if you can lift the rents up. Always take the feedback you get from the real estate agent who is selling the property. Always take that with a bit of a pinch of salt, and make sure that you double, triple check their views on the end value of the project, which is after repair value, for example, or the rental market. Get 2 or 3 appraisers on that. This is something which I highly recommend. And obviously, when you target specific area and you've been looking at that area for a while, you should have an idea, some broad idea of achievable market rents and values as well.
That's for any investor at any level. Folks who are on our mailing list will know that we are currently promoting a development in Christchurch, and this is 40 apartments in the CBD, and the developers for that went and got 4 rental appraisals because they wanted to be absolutely sure that they were making a product where the numbers were real and it would work for investors. So this is not just for the first time, your second time. Folks have been doing this for 10, 15 years, big developments. These basic checks about, go and verify the figures, get a couple of even verbal estimates of values or rental appraisals, or have a couple of builders come and give you contrasting quotes. It doesn't cost a lot of money and it doesn't cost a lot of time, but it can save you a lot of downside, and it can also give you, you might get a different angle on the upside that you wouldn't have seen otherwise.
Yes, and that also shows you that you're dealing with a good developer who cares about the product and want to make sure he covers all the bases, and there is integrity there. And I think I've seen those 2 those deals of the apartment building in Madras Street. I've seen them on your website, and I've seen them on propertygenie.co.nz when you listed them there.
Right.
And I think they are great deals. I think there's quite a unique opportunity there to purchase something which is dual key, and it's a new build with the current building code and all the required strengthening. And Christchurch is a growing city. And it's going to be, in my view, one of the nicest cities in the world when they finish with that, because there's amazing plans over there, and the parks and all the greenways, and the return. The return is there. The yield, I really think it's a good opportunity.
Yeah, it's going to be. This isn't a sales pitch for these properties, by the way, everybody. But if you are listening and you have been sitting on the fence, get in quick, because I think they will be all gone very, very soon.
If I wasn't in the middle of a couple of projects at the moment, I would most likely try to secure one. I'm still really, really thinking about it. I was talking to Mark Honeybone just the other day about it. I told him if he can try and put one aside just to see how we get on. But I'm just in the middle of a couple of projects, and I just want to make sure I don't overcommit.
Well, I'm buying one. I'll let you know how it goes.
Yeah, I'm sure it's going to be good.
Well, that's not how I plan to end this episode, but we'll cut it off there because we've still got about another 40 minutes of content for you next week. Hadar is going to talk about how he invests in Auckland from down in Central Otago. He has built up a successful trading business, joint ventures business, and he has a really rock solid buy and hold portfolio. Tune in next week for the second half of this interview.